Hi, I'm Eric Dobson, and I'm here to talk to you about due diligence today with regard to startup companies. So this is how to conduct research on these companies so you can become a successful investor. So why should you listen to me? Pretty simple. I lead an angel group and a venture fund. We've had 7 profitable exits in the last 5 years. We've got 12 more pending over the next 5. We feel strongly we'll exit and exit well. So we learned a lot of lessons the hard way. I was also an entrepreneur before I became an investor. So I've been through this whole process, both sides of it. So the first thing you need to know is 20 hours of research improves your chances of success by 500%. Again, that's 500%, 5 times more likely to gain a profitable return out of a startup company with only 20 hours. And that should really tell you something important. It should tell you that most of the problems that ultimately bring these companies down are fairly easily discoverable. It only takes a modest amount of time and effort to identify the key failure modes here. And that gets easier and easier as you do more and more of it. Do I need, the first thing to an entrepreneur is always going to ask is, do I need a business plan? And the answer is yes, you do. You need a detailed, supported, and defendable financial projection set as well. We need to understand because we understand how you conceive your business, because if you can't plan a business, you can't run a business. And we've learned that the hard way over many, many years. The goal is to quantify the known and knowable risks of the venture. And entrepreneurs are well trained to provide that information, obviously, and investors have to be tuned to listening to that and to understanding the risks involved just to be successful. Because you need to understand another big concept is this is a deselection process for investors. Most investors that are doing this on a regular basis see too many deals to spend even 10 minutes on a mediocre deal. We're looking for again, transformative entrepreneurs. We're looking for business plans, because if you look at the math of this industry, if you invest in 10, 4 to 5 will completely fail. 3 to 4 will return the capital you put into them, and the 1 to 2 at the upper end are really the ones that pay for everything. So we're looking for ventures that can realistically return 10x on our money, because that's the only way you can make profit with those kinds of results. Now, here's the other thing an investor needs to understand about diligence, and entrepreneurs. An investor needs to say yes 16 times to a deal, 16 times, and no only once. And you'll see in just a second why I say that. There are a lot of elements of diligence, and they're independent, and each one functions as a stage gate. So, some of the questions we'll be asking when we begin looking at a company is, has the entrepreneur done his or her homework? Is the business concept novel and valuable? Who cares? Does someone really care enough to spend money on it? Is this a winning team? That's a difficult thing to assess, but it's a critical thing. Can an investor find experts to opine on the opportunity and validate it? Is the market size, fit, and adoption rate and timing right? That's a big set of questions. Does the entrepreneur have a solid business plan, including marketing, sales, and exit plans? Again, if you can't plan a business, you can't run a business. Does the business have sufficiently detailed financial projections, and are they realistic? It's very easy to determine if someone's ever run a company very quickly by looking at their financial projections. It's obvious if they've run a business before, and if they understand how to scale a business, it's very obvious from those projections. Have they priced the stock appropriately? That's always a huge question and concern. Again, are they using standard industry terms and legal documents? More elements, things you don't think about normally, perhaps. Has the entrepreneur created barriers to entry or developed a uniquely valuable offering? In other words, have they created some intellectual property to slow down fast followers, or have they created something that's uniquely valuable that drives adoption of their product and ultimately, acquisition of the company? Does the business have sufficient market and sales traction? By that we mean engagement with clients, with customers. Do they have customers? Is the M&A market active, and can they create a company ripe for acquisition or IPO? That's a big question and sometimes hard to determine. Is the company structured properly? Some simple things in structure can be catastrophic if not executed properly. How much money has the company raised, and are the terms and share prices appropriate? Who else is and has invested in the company, and are they continuing to invest? And of course, are there any red flags on background checks? Every savvy investor is going to do background checks on the entrepreneurs just determine. Only once has it ever come up with something that was off-putting enough that we said no to an investment, but it does happen. And of course, then there's always what we call the final gut check. After all this work, do you still feel good about the company and the team? This is the team you still want to be involved with for several years on a regular, certainly monthly, possibly weekly, and at times daily basis. So it's an exciting and potentially highly profitable activity, and it's a lot of fun working with startup companies. The average industry returns are 2.6x in 3.4 years. So it's a very high performing asset class. That's somewhere between 2 and 10 times what you'd think of from banking or, investing in the stock market typically. The S&P 500, specifically. So in there. Finally, of course, diligence is the difference between winning and losing at this game, this industry, however you want to say that. So what's the outcome? Well, when it works, everyone wins. It's pretty amazing. Entrepreneurs make life-changing wealth. Investors create new wealth, and they invite their friends and colleagues to join, which further reinforces the community, and the community tends to blossom. And ultimately, if you do this well, what you have is a self-reinforcing ecosystem. So I hope you've enjoyed this quick discussion about diligence on companies, and look forward to talking to you again soon.